The reason you're not profitable is because you've chosen a strategy that is psychologically brutal without even realizing it. One of the most important decisions you will ever make as a trader is your risk to reward, and most people choose the wrong one. So in this video, we're going to cover exactly how a one-to-one risk to reward will make you a consistently profitable trader. We're going to cover the maths of winning and the risk to reward paradox, why high risk reward strategies actually destroy your consistency. And then we're going to cover the winner's effect, how frequent wins actually rewire your psychology and boost your confidence. They affect your testosterone, your dopamine, your motivation, which then leads us onto the law of large numbers. This is the reality of trading and losing streaks, and how you actually get to choose how big your losing streaks are. And then we're going to cover the most important topic of this training, which is the variance trap. One of the most important things for you to understand is the variance of your strategy. And we'll also cover some other psychological concepts to make it a lot easier for you to get the consistent results that you want. I constantly get asked what matters more, a high win rate or a higher risk reward. But the thing that actually truly matters is the win rate and the risk reward combined. Do they lead to a positive or negative expectancy? The expectancy of your trading system, how much you're likely to make off each trade, and what will actually define if you're a profitable trader can be found through your average win rate times your average win minus your losing rate times your average loss. That will give you your expectancy. And so the whole goal of becoming a consistently profitable trader is to have a positive expectancy. And you actually get to choose how much you win. And you actually get to decide on your win rate. You can choose to have a high win rate and a low win rate, because this is directly affected by what risk reward you target on average. As we can see here, the higher our risk reward, the lower the win rate needed to become a consistently profitable trader. If I have a 1 to 3 risk reward, I can make money with a 30% win rate, which sounds great. Most gurus online will tell you just target high risk reward. You only need to win 30% of the time. And so you do that, you go through a series of 6, 7 losses in a row, and you think there's something wrong, and then you switch your strategy and you never stick to anything consistently. This is the hidden trap of high risk reward tradings. They sound great on paper, but in execution, they are psychologically draining. You can get the exact same results of a 3R risk reward system with a 30% win rate with a 0.5R system with an 80% win rate. These two systems are the same level of difficulty. They're the same expectancy. You can also target a 1 to 2 risk reward with a 40% win rate. But on average, I find the best is around a 1 to 1 with a 60% win rate. And these all have the same expectancy. But the thing is, your win rate plays a massive role in your consistency and your psychology. And we'll cover exactly why that is. So most traders online push a high risk reward system because it sounds mathematically superior. In theory, you can be a profitable trader with a 30% win rate. I only have to win 3 out of 10 trades, which sounds amazing. You know, I have so much more room for error. But in reality, most of the time, you're going to be losing 7 out of 10 trades on average. You're going to be consistently hitting massive drawdowns of 6, 7 losses in a row. And most traders can't handle frequent losses. It destroys their confidence and makes them strategy hop. On paper, a high risk reward system might be optimal, might be the perfect strategy, but you already know from your own experience, the issue is your execution. You can't consistently stick to it. You can't stick to your rules. You keep on breaking your plan, taking revenge trades, strategy hopping, or you just lack motivation. Your whole nervous system is working against you because you don't understand the winner's effect. The winner's effect is a biological phenomenon where an animal that wins a fight becomes more likely to win the next one. It also applies to humans as well. Success causes physical and chemical changes in your brain, such as increased levels of hormone like testosterone and dopamine, which can boost confidence, focus, and motivation. How often you win in trading will directly affect your hormones. It sounds a bit fucked, but this is the reality. And this self-reinforcing loop creates a cycle where early wins lead to more wins, while the loser effect can cause the opposite, making it harder to succeed after a series of losses. And this is a real documented phenomenon. Winning will lead you to more winning because consistent winning increases your dopamine, your motivation, and even your testosterone. You know right now, you probably could be doing more than you are. Most of you aren't even probably journaling your trades at all. You might say you lack discipline or you lack motivation, but it's simply your nervous system working against you. Journaling your trades is extremely hard when you're losing all the time. The times in my trading career where I didn't journal my trades was after a series of losses because I just lacked all motivation. I was, low on confidence and it psychologically wrecked me. And it was simply because I was targeting too high of a risk reward. And so as we covered, you will trade best when you're the most confident. You'll be the most confident when you're winning. You're more likely to win when you have a low risk reward. And so if you really want to be consistently profitable over the long term, your trading system has to work with you, not against you. And so let's actually cover the reality of high risk reward systems through the law of large numbers. So over a large enough sample size, probabilities always play out, and they're always a lot more extreme than you realize. So with a 50% win rate, you have a 97.1% chance of losing 6 or more trades in a row. And with a 50% win rate, you're almost guaranteed to go through 6 losses in a row. And so ask yourself, if you went through 6 losses in a row, and that can look like a whole week of trading if you're taking 1 trade a day, would you think there's something wrong with the strategy? Would you change things? Would you hop to a different strategy? Most traders would say yes, but this is just the reality of your trading system. You're going to go through these massive losing streaks if you have a lower win rate. And when you get into the territory of targeting 2R, 3R, on average, you're going to have around a 30% average, and that's a nice profitable strategy. But you have an 82% chance of going through 9 losses in a row. Could you go through 9 losses in a row and stick to your plan, execute flawlessly? Probably not. I couldn't do that. Most people can't do that. And most people try to treat themselves like a robot. I should be able to execute without emotions, but that just never happens. You are human. You should choose a system that benefits you, where there's a lower chance of having, 4 losses in a row. And with basic probabilities, the higher your risk reward, the lower your winner will be. And these losing streaks will be longer and more frequent. If you're going to do this consistently, you're going to make a career out of trading. Do you want to be going through 5+ losing streaks, 6+ losing streaks? Because this is over a 50 trade period. If you take 1 trade a day, every 2 months with a 50% win rate, you're going to go through a 6 losing streak. If you're risking 1% per trade, that's going to be 6% drawdown. And so that's just the reality of trading. As your risk reward increases, your average drawdown will also increase. And this then leads us into variance, which is the hidden killer of consistency. Variance is just the difference between your best and worst possible outcome for your system. And so you might have seen these Monte Carlo simulations where you can just input your statistics and you can test 100 different simulations and you can see all the different types of equity curves. The variance is just the difference between the worst possible outcome and the best possible outcome. And this is with a 50% win rate. If we put it onto an 80% win rate with a similar sort of expectancy with a 0.6R risk reward, you can see the variance between the best and worst outcome massively decreases. And so variance is pretty much the stability of your equity curve. It's how consistent and stable your returns are. The higher the risk reward, the higher the variance. The lower the risk reward, the lower the variance. And variance is directly tied into the consistency of your profitability. It's how consistent your returns are, how consistent your equity curve is. A low variance system will look something like this. A steady uptrend. A high variance system will be all over the place, really volatile. You might be moving bullish, but you have these massive fucking swings that go everywhere. And so if your goal is consistency, to be a consistently profitable trader, high variance destroys that goal. And this is why lower risk reward systems produce more consistent growth and less emotional turbulence. And so the consistency of your profitability is directly tied into that variance, and variance is directly tied into your risk reward. You actually get to choose how consistent your trading is. That is one of the things I wish I knew when I first started trading. I get to choose how consistent my returns are. And if I actually understood that, I never would have went down the high risk reward trap. And then this ties it into another key benefit of low risk reward systems, which is frequency. It seems pretty obvious that small moves happen more often than big ones. The market offers far more opportunities to take 10, 20, 30 pip moves than it does 100, 150, 200 pip moves. This means you'll find more setups when you're targeting smaller moves, smaller risk rewards. And so a higher trade frequency with a lower variance, a more consistent return leads to a faster learning curve, which then leads to faster feedback, more opportunities to learn, refine your edge, and improve. And this also leads to speeding up the compounding effect of your trading account. The more frequent the trades and the more stable the variance, the quicker your trading account will also compound. And this also enables another benefit, which is that smaller targets remove the pressure from individual trades. If you're taking a higher frequency of trades, each individual trade matters a bit less. You've probably gone through this where you've taken a couple trades, maybe taking a couple losses, and you're in drawdown and you're about to take another trade that looks pretty good. Almost matches your setup to the T. But you might second guess, you might hesitate, you're in a bit of drawdown, and so you pass on that setup. But that was the one high risk reward setup that could have made all your money back plus more. And as these moves happen less, there's so much more pressure around them. And when you miss one, it mentally fucks you. But it is important to understand in trading that pain can't be avoided. But you do get to choose your pain. And so when you're choosing your risk reward, choose the type of pain you want to experience. Would you rather more frequent losses, deeper drawdowns, and lower confidence from choosing higher risk rewards? Or would you rather the pain of closing a winning trade early and watch it go on without you? Thinking about all the P&L that you could have made if you just held your trade. Every single decision you make has a trade-off. There is no perfect decision. You just have to choose the one that is sustainable for your own personal psychology. And so another benefit of targeting lower risk reward trades is that because of the smaller drawdown, it actually increases your ability to risk more per trade. And so on prop firms, it means that you're able to pass challenges a lot faster, and you also have less risk of breaching these drawdown limits. Especially on futures prop firms as well. They have these consistency rules where you can't make too much of your profit on one day, which also then benefits lower risk reward because you want high consistency, you want lower variance. So just to leave you with a final principle, make a system that works with your nervous system, with your psychology, and not against it. The best trading system isn't the one that's most mathematically optimal, it's the one that you can execute consistently. You're not a robot, you are affected by your emotions, and that's okay. But unfortunately, none of this matters if you don't have a positive expectancy. So watch this video next, where I break down my personal trading strategy that I use every single day.